Hey everyone, you're not going to believe what I just read. And for those of you that know me, I'm always looking for really important data to talk about or really interesting perspectives. And I actually came across an AI-driven housing study led by Erkan Yonder at Concordia University with Equiton. It dropped a prediction for 2032 and it literally stopped me cold. This is not some random clickbait headline. It's literally a report and it's the first of its kind. And the picture it paints, it will touch every single one of us. Whether you own a home, you want to buy one, or you think you're sitting this one out. This is something that you want to listen to. We're talking about budgets blown apart, entire neighborhoods reshaped, and a price tag on a middle-class home that looks like it belongs in the luxury market. I'm Linda, one of the Ragona Sisters, and I translate complex housing data into decisions you can actually use. So if you can, please like, share, and subscribe because today I'm going to show you the possible future we're walking into if Canada doesn't get serious, according to this report, about building homes. Whether you own a home or you're hunting for one, or maybe you're waiting for the right time to buy, this is your wake-up call. So here's the reality. Home prices could stabilize in Ontario and in BC in the next 3 to 5 years, but only if we break ground on substantial wave of housing starts this year. Now let's dig into the nuts and bolts of this report because it gets pretty interesting. If Canada keeps building at today's sluggish pace, with the average number of newcomers that we've been seeing over the last 7 years, Toronto's median home price could hit, wait for it, $1.8 million by 2032. That's what stopped me cold. And that's in today's dollars. But wait, get a load of this one. In Vancouver, it's $2.8 million by 2032. And no, that's not the luxury market. That's the middle class budget. Now take a breath. You hear the phrase housing starts all the time, and it sounds boring until you see what happens when they stall. And this is pretty much what this report's indicating. We're going to talk about why housing starts are the single most important leading indicator in Canadian real estate and how they tell us the future of this market and how the study quantifies the exact pressure points. That ripple goes through every single neighborhood in this country. So let's hit you with a fact. The report shows just how fragile our housing pipeline really is. A single 10% increase in input costs like materials, labor, fees, and taxes can slash housing completion by 25 to 35%. And apartments, they're hit the hardest. Now let's dig into this report even deeper. Canada's housing market is in crisis, it says. We knew that, right? The result of a chronic undersupply colliding with relentless demand. And some of you might say, but there are so many listings right now in Ontario and BC. Sure, that's today. But this report is forecasting what's coming in just 7 years if we don't increase our housing supply across the board, because what happens today dictates our future. So let's continue, shall we? Investor returns in hot markets are still strong today, but affordability, that's a big issue. It's slipping further out of reach, putting pressure on households and forcing policymakers to act. Fixing this isn't just about building more homes. As a report states, it's about understanding the forces that shapes both supply and demand. The research dug into municipal regulations, construction costs, demographic trends, and even global price shocks to find what really moves the needle. So let's anchor the basics. According to the research, Canada is completing homes at roughly 1.75% of existing dwellings per year. If we double that, yes, double that, it would likely stabilize price growth in Toronto and Vancouver. Not crash prices to the floor, but keep them stable. Now let's get more specific and look at city to city. So let's take into account Toronto first. And at the current pace, so if we kept everything the same that we're doing today and bring it into the future for the next 7 years, the model projects the median price rising from roughly 1.4 million in 2024 to 1.8 million by 2032. Keep in mind the recent policy factors in the reduction of non-permanent residents, which helps stabilize prices temporarily until 2027. After that, population growth is expected to normalize according to this report, averaging between 400 to 500,000 new residents per year. All this was taken into account in the report when the forecast was calculated by AI. So let's look at what would happen if we doubled the housing starts in Toronto. If completions doubled, meaning more housing added to the supply, prices would be closer to 1.6 million by 2032. The difference is $200,000. It's the difference between we can do this to we're priced out. So now let's look at Vancouver. The study even allows for a modest dip this year as policy and immigration flows rebalance. But at today's building rate, the median price still trends towards 2.8 million by 2032. Yes, that's a real number, and that is ridiculous. A 50% boost to completions barely moves the needle. Only a true doubling would flatten the curve somewhat. And when Yonder was asked if doubling was possible in Vancouver, his answer was blunt. It's very costly. It's very difficult. So, let's look at what would happen if we doubled the housing starts in Vancouver. It would see prices averaging around 2.2 million by 2032, which is significantly less than the prior graph. Now, Montreal is much more different, with construction around 1.19% of housing stock, almost half of Vancouver's. The model suggests even big increases won't fully arrest price growth, but at today's building rate, the median still trends toward 800,000 by 2032. Demand is that strong and prices will have room to run compared to Toronto and Vancouver. That's what economists call the wrong side of the inverted supply curve. More supply helps, but demand absorbs very, very quickly. So let's look at what would happen if you doubled that housing start. Montreal would see prices increasing to over 900,000 by 2032. So that's what we call inverted. Now let's look at Calgary, very different as well. It responds more to migration and population swings than to supply tweaks. The model sees a pullback from immigration-driven peak around 740,000 in 2024, staying below that peak regardless of building pace. But at today's building rate, the median price still trends toward around 625,000 by 2032. Translation: watch who's moving here and why, more than how many cranes are up. So let's look at what would happen if we doubled the housing starts. Calgary would see prices lowering, averaging out just around 700,000. Interesting stuff, guys. Here are the key factors the research measures and reports on. Improve a city's regulation index, think zoning friction and assessments by 10%, and you get roughly 10% more completions. Cut approval timelines by 10%, and output rises around 3%. Those wins don't cost taxpayers a single dollar. On the flip side, a 10% increase in input costs can shrink completions by 25 to 35%. And again, that's devastating to apartments. That's the quiet link between trade policy and what a one-bedroom costs. And that's why these trade wars are so impactful on housing starts. The very same supply chain headline you scroll past on your phone about supply disruptions, shortages, or policy changes in the materials and logistics that feed this construction industry can delete an entire future building months before anyone notices, and at the same time dramatically increases home values, according to this report. Fewer starts today equals fewer listings, fewer rentals, and steeper prices for tomorrow. That's why this isn't just abstract economics, it's your life. So let's talk about capacity. The report makes it clear doubling completion isn't just a memo, it's an entire ecosystem. And if you take anything from this report, it's the building more is essential to affordability. That means trades in training, factory lines for materials, transport logistics, enough inspectors, planners, and with every link stretched, cost increases. Push demand for labor and goods too fast and prices jump. When construction costs jump, marginal products get shelved. And the project you skip means a family without a workable housing option later on. The report concludes that cutting municipal red tape isn't just a nice idea for government press releases, it's one of the most cost-effective ways we have to actually get more homes built. Some cities that started tackling these bottlenecks in recent years are already reaping the benefits. You can see it in faster builds, more units coming in the market, and little more breathing room for buyers and renters. But let's be clear. Approvals alone won't solve Canada's housing crisis. You can unlock supply all you want, but construction costs keep climbing. If materials stay expensive, if skilled labor remains in short supply, and if our population keeps growing at today's pace, prices will still be under pressure. The housing crisis is multifold, and our immigration policy, it directly shapes whether new supply can truly take the heat out of the market. So the truth is, this is both a supply problem and a demand problem. You can't just pull one lever and expect affordability to magically fix itself. This is a generational challenge. And what's powerful about the first of its kind research is that it gives us hard numbers, real, measurable targets. Canadians aren't just asking for solutions anymore, they're demanding them. So now let's circle back to the study's 3 potential futures. Scenario 1, the ambitious fix. We double completions in Toronto and Vancouver. Prices still rise, but a manageable slope. Toronto lands closer to 1.6 million, Vancouver around 2.2 million. Affordability improves relative to the alternatives. Families can plan, investors can underwrite without betting on a real estate bubble. Scenario 2, the status quo. We keep along with this 1.75% of stock per year. Toronto heads to 1.8 million, Vancouver towards 2.8 million. Bidding wars flicker on and off. First-time homebuyers chase the dream of home ownership. Move-up buyers juggle capital gains on investments and the cost of trading up. And then there's scenario 3, the setback. This is a terrible one. Material costs spike, approvals crawl, completions slip towards 1.5%, the price paths overshoot, and affordability erodes sharply. That's where investing in a downturn only works if you own stable cash flow, not speculation. So which future are you planning for? If you believe in scenario 1, patience and quality are your friends. In scenario 2, feels more likely, speed and clarity help. You buy before the next increase. In scenario 3, scares you. Looking in a home that works for your life today may be the safer path. The research clearly states at today's pace, Toronto drifts towards a 1.8 million and Vancouver towards 2.8 million by 2032. Doubling completion would cool these paths, or reducing immigration, I would imagine, can cool these paths down as well. But raising costs induced by trade wars is already slowing approvals and slowing things. That's the fork in the road, guys. Every single policy lever we pull has to work alongside smarter cost controls. We need to make some serious changes. My promise to you, I will keep reading the dense reports, testing the numbers against what I see in the field, and giving you practical plain English playbooks. I'll tell you when the data says wait, and I'll tell you when it says go, even if it's not popular. So, does this AI-driven report make sense to you? Do you agree with the analysis? I'd love to hear your comments below. Or do you think this analysis is completely off the rails? Please remember to keep the comments respectful. Until then, breathe, keep perspective, and just remember the housing starts are the drumbeat of our market right now. Thank you so much for watching, and we'll see you in the next one.